Hello world and welcome to my channel. My name is Zach and I want to help you with investing by showing you how I do it for myself as well as 9,000 other people on eToro. Today we are going to have a reaction to Warren Buffett cutting his stake in Apple. Now Warren Buffett's company is called Berkshire Hathaway. Berkshire Hathaway is a holding company that invests in different companies within that. So it's like a holding vehicle. And Apple happens to be one of their largest positions. But recently, at their latest 2024 annual shareholders meeting, they revealed that they cut back on some of their holdings. So without further ado, let's watch the video.
Just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration.
Okay, first of all, I want to say if you're 27 years old and you own Berkshire Hathaway, kudos to you, man.
Partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
No, I would. But we have sold shares, and I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have now. One interesting thing is that Charlie and I looked at common stocks or marketable equities or the things that people love to look at as being businesses, and so when we own a Dairy Queen or we own whatever it may be, we look at that as a business, and when we own Coca-Cola or American Express or Apple, we look at that as a business. Now, we can buy really wonderful companies in the market as businesses. We can't buy all of them. All of their shares. We can't buy 90% or 80% or anything like that. But when we look at Coca-Cola and American Express and Apple, we look at them as businesses. Now, there's differences in tax factors, there's difference in managerial responsibility, a whole bunch of things. But in terms of deploying your money, we always look at every stock as a business, and we have no attempt made to predict markets. We have no attempt made to pick stocks. I went through many years.
Okay, so Buffett mentioned quite a few interesting points here. So first of all, he mentioned that he sees every company as a business. And he does see Apple as running a very good business, just like the other companies in his portfolio. So this doesn't mean that he sees Apple as a bad stock, or that it should go down or the stock price should go up. Again, at the end of it, he says he doesn't make any predictions about the market itself, but he did reduce his stake. So the question is why? Well, even if you look at our portfolio on eToro, which is right here, you can see that one of our positions, which is one of our largest positions, actually Fin. And recently, I actually sold some of this. There we go. And this is not to say I think Fin is a bad company. In fact, I think it's a great company and still undervalued to this day. But I sold it because it constituted too much of my portfolio at the time. I didn't want my portfolio being just related to this one stock going down because there are many risks involved, unforeseen or foreseen. And it was kind of the vibe that I was getting from Buffett. He's saying it's a great business, but he just doesn't want it to own so much of it because it's just too large a percentage of his portfolio. So let's go on.
Doing the wrong thing. I got interested in stocks very early, and I was fascinated by them. And I wasn't wasting my time because I was reading every book possible and everything else. But finally, I picked up a copy of The Intelligent Investor in Lincoln, and there was a few sentences in there that said much more eloquently than I can say it. But if you look at stocks as a business, and treat the market as something that doesn't tell you, isn't there to instruct you, but it's there to serve you, you'll do a lot better over time.
So this is one of the tenets of value investing, which is investing in the fundamentals of a company. All that means is that instead of looking at the market and predicting where it's going to go, you instead look at the balance sheet and its financials that they publish and see if the company is making money and how they are making money and how efficient are they making money. So what Buffett is saying here is that instead of looking at the market, depending on the market, we prefer to see every company that they buy as a business itself. And if the business is doing well, then we buy it. If the business is not, or we can see some headwinds in the future, we don't buy it. Now, again, this is a very specific strategy. It is value investing. And I see myself very much as a value investor. I do like looking at financials and things like that. But at the same time, you do see other YouTubers or other people having different styles, like growth investing, which doesn't really look at the financials as heavily as Buffett does look at these, and doesn't enter or exit them at the same kind of levels that Buffett's looking at or value investors are looking at. Of course, there are a lot of different investors and a lot of different types, but what I like about value is that it's probably not going to lose you that much money even if you get it wrong. And that's what I like about value.
Then if you try to take charts and listen to people talk about moving averages, and the way I've been allowed to deploy it, and Charlie and I talked about this, of course, constantly, it's changed over the years as the amount of capital we have and has changed and all of that. But the basic principle was laid out by Ben Graham in that book, which I picked up for a couple of.
Yeah, you mentioned the term moving. It's just another style of investing. Analysis looks at a lot of charts and price movements. Necessarily, you may or may not want to get into it. Personally, do use it, but for different reasons.
Dollars, and which basically said to me, "You've been wasting your time now, but maybe you can use what you've learned or been reading about and put it to better use." And then Charlie came along and told me how to put it to even better use, and that's sort of the story of why we own American Express, which is a wonderful business. We own Coca-Cola, which is a wonderful business, and we own Apple, which is an even better business. And we will own, unless something really extraordinary happens, we will own Apple and American Express and Coca-Cola when Greg takes over this place. And it's such a simple approach that it's almost deceptive. Most things, if you keep working harder and harder at it, you learn a little more math or you learn a little more physics. But investments, you don't really have to do that. You really have to have your mind set properly. So we will end up, unless something dramatically happens that really changes capital allocation, a strategy. We will have Apple as our largest investment, but I don't mind at all, under current conditions, building the cash position. I think when I look at the alternative of what's available.
Buffett said something really interesting about holding cash. So one of the reasons that he sold out his position is really huge cash. And that is something that I do in my portfolio as well, because if the market were to drop, there's opportunities. We have to go buy something. So I want to touch on something else that he mentioned. Because of his size, there are different things that we should do and the investors may be able to do. One good example, if you look at a company I buy, they could be on the smallest. It's not that I don't like big companies like Amazon and Meta and Tesla, all these big names. It's just the instruments given us to express certain views are not as comprehensive as someone like Warren Buffett would have. Example of this would actually be options, right? Options are very, very useful. Let me show you. Okay, so I asked my analyst, or my favorite analyst at GPT, to help me with this part, right? So one of the things that Buffett has said is that derivatives are weapons of mass destruction. And what he means by that is, you can lose a lot of money using derivatives. But at the same time, Berkshire Hathaway has been selling a lot of selling a lot of options, and this creates value. Okay, I will get into the details of that, but what it's trying to say is that for him, because he's such a big fund and because he has these views and he expresses them, he doesn't just buy the stocks. He also buys or sells derivatives to help increase that value. On eToro, I can't do that because options are not available, nor do I think they should be because, again, they are very dangerous if put in the wrong hands. But have a look at this. You can see the risk of derivatives by weapons of mass destruction. But at the same time, he strategically used options to benefit Berkshire Hathaway's. At one famous instance in 1993, he sold put options at a strike price of $35. Okay, what this means is that if the stock drops to $35 or lower, he's willing to pay $35. So the stock drops to $28, he says, okay, I'm giving you this contract which says I'm willing to pay $35 for it, even though the price is lower at the time. And the reason why you would do that is because by selling this contract, actually get some money in return. So you can see how much he gets here by collecting $7.5 million in premiums. And the reason why he did that again is because of his value investing. He thinks $35 is a reasonable price for Coca-Cola shares. But if it doesn't drop to those levels and stays above, he would just collect the premiums from selling that contract. Okay, and this one is another famous example in 2008. He did the same thing, but for the entire equity index. And here he sold $9.4 billion worth of put options on the equity index, banking on the fact that the financial crisis would not decimate the US, but eventually would recover. And that takes a lot of guts because during 2008, I just started trading, and it was so scary. Everyone thought the whole financial system was going to collapse. And he went out there and he said, okay, you know what? I don't think it's going to collapse. In fact, I'm going to put my money where my mouth is. I'm going to sell you these contracts. If it drops below that, I'm willing to pay you the difference. So these are things that people in professional settings can do that we are not able to do on eToro. But at the same time, like we mentioned just now, we do have certain advantages. Warren Buffett needs to go after very, very large companies. Like $1 billion company is probably too small because of the amount of capital he has to deploy. And you can imagine if you're like 49 billion or whatever have you, and you want to invest in 100 companies, which is already very difficult to manage, right? 100 companies. At $49 billion, is the minimum size you need to buy is about 500 million every time. Which stocks can take that kind of size? Because if your company is worth 1 billion and you're paying 500 million and buying that stake, you own 50% of the company. Do you really want to own 50% of the company? That becomes a very, very dangerous bet, especially at that size. So it becomes very interesting when you look at the differences between value investing at a high level and investing at our level, which a little bit more retail, but also has its advantages.
Available in the equity markets, and I look at the composition of what's going on in the world, we find it quite attractive. And one thing that may surprise you, but almost everybody I know pays a lot more attention to not paying taxes than.
So in the rest of the video, he goes on to talk a lot about taxes and stuff like that. I won't get into that. That's a whole different topic. Again, the reason why I want to create this video is because he did sell his stake in Apple and reduced it by quite a bit. But doesn't mean that he's bearish on Apple itself. He just thinks that, given his portfolio, given he wants to hold some cash, he doesn't mind selling some just to reduce the exposure. And again, we have done the same in our portfolio, and we learn from, of course, Warren Buffett's one of the greatest investors of all time. So we learn from that and try and adapt that to our style. But at the same time, it's also important to recognize that, he's so big, he has so much capital to deploy, he has certain advantages, and we have certain advantages as well. So how do you balance the two? I think that's where you come up with a different investment strategy. And that's what I try and do in eToro. Again, all this is very complex and very frustrating. That's why I do eToro, is so that I can help other people invest their money. Again, this is not financial advice in any sort of manner, but If you do want to have a look at my portfolio, the link is in the description below. Yeah, and that's it for today, guys. Thanks so much.